In the last video, we talked about fixed pricing agreements, the idea being the buyer and the seller get into a contract and price in that contract remains fixed throughout the life of the contract. So the problem, if you looked at that video, was that cost was never really defined, or rather was never really looked at in detail. In this video, we're going to talk about cost plus pricing agreements in which we look at cost in detail. The idea behind cost plus pricing is fairly straightforward. You figure out how much it costs you to make your product or service, and then you add a markup, and that gives you your asking price. Now, in order to do that, you can follow the following 3 steps. The first step is to determine the total cost of your product or your service. So in order to do this, you need to understand the difference between direct cost and indirect cost. Direct costs are the kind of costs that are associated with producing whatever it is that you are producing. Indirect costs are pretty much any other cost that cannot be directly attributed to whatever it is that you produced. So when it comes to figuring out the total cost of your product, you will need to know the direct cost of material, direct cost of labor, and direct cost of overheads. Basically overheads associated with the production of this product or this service. So now that you have your total cost, that is direct material plus direct labor plus direct other expenses. Now that gives you the total cost, right? But you need to know what is your unit cost. And that means dividing the total cost by the number of units that have been produced. And that will give you a unit cost. Now that you know how much it costs you to produce a unit of whatever it is that you're producing, you multiply that by a markup percentage, and that will give you your asking price. The markup will depend on your business's internal rate of return or whatever strategy that you decide to use as a company. Now, if you don't know how to calculate IRR, there's a video link in the description or somewhere in this video that explains how to do that. So let's make this practical. Let's assume that you're running a business and the following are the figures in relation to your business. Direct material cost is $50. Direct labor cost is $20. And allocated overheads, in this case, are $10. Your total cost now will become $80. Basically, you're adding all of those ones. Now, let's assume that your company applies a 30% standard markup to all of its product. So in this case, in order to figure out your asking price, you will take the 80, which was the total cost, and add that to 30% of 80, which in this case is 24. Okay? So your asking price is going to be $104. What this means is that the cost plus of the product is 80 plus 24. That is 80, which is the cost, plus 24, which is the markup, and that will give you 104, which is your asking price. So your cost plus pricing is $104. Now, there are a number of strategic and tactical benefits of using cost plus pricing method. Those include, it's easier to communicate and to justify. Now, if you're dealing with your buyers and then you want to explain why you've just increased your price, you can always tell them that, look, our input costs have just gone up by 6%, and here's why. And as a result of that, our costs, our prices are actually going to also go up by 6%. The second thing is that it's simple and easier to implement because all you need is a calculator. Basically, you just need to figure out your cost and your markup, and you are done. And the third thing is that it assures you of the profit you're going to make because as a contractor, you have your cost, which you already know. And then you have your markup, which you also know. So at the end of the day, you know how much money you're going to make as far as the project is concerned. But then again, cost plus pricing as a strategy has a number of justifiable drawbacks. And such include, it ignores the competition. Look, while you're busy trying to add markup to your costs, the guys you're competing with are probably not even doing that. They are busy doing something to their price so that they can gain a market share. So that's a disadvantage. Okay, you have to factor in the competition when you're coming up with your price. In some cases, actually. The other setback in relation to this is that if your costs are low, then that means it doesn't matter what your margin is because the overall asking price is going to be low. Remember, if your cost was 80 and your markup was 30, as you did in the example, then you end up with 104. Now, if your cost is 50 and your markup is 30, you do the math. Now, that covers the lesson of cost plus pricing as a way of trying to arrive at your cost in procurement or in supplies. If you have any question, do let me know. I'm Moses from The Right Network, and I'll see you in the next lesson.